Hello, and welcome to Financial Planning Unlocked.
The contents of this podcast do not constitute a recommendation or advice, and no action should be taken without seeking advice from a financial planner. The opinions expressed in this podcast are not necessarily the views held throughout Rathbones Group.
Hello and welcome to Financial Planning Unlocked with me, Simon Maiden, Director at Rathbones Financial Planning. Today I'm joined by two specialists from Henry Donnell, Jamie Roberts and Stephen Burke, who are senior mortgage and protection advisors. So at Rathbones we have a great number of tools available to help our clients achieve their objectives, but there are times when we reach the edge of what we can do. And it's at those times that we have to lean on other specialists to help our clients achieve those things they are looking to do. So Jamie, you focus primarily on mortgages. We have a lot of clients at Rathbones who are asset rich, but perhaps they've retired, their income is much lower, and they perhaps don't want to access their invested assets, their portfolios, for a number of reasons. Maybe they don't want to create tax liabilities, they don't want to disrupt what their investment manager's doing. How can you help in the mortgage market with these such clients?
It's a very topical discussion right now with, as you say, many clients possibly not having the general income that many of the high street lenders traditionally would like to see. What we have noticed over recent times is that many high street banks are moving into more of a private banking holistic nature with that of criteria. And what we can look to do is use potential portfolios, creating a notional income, which will allow the client to have a stream of income being used the same way as kind of a PAYE basis would be looked at. The benefit here is that, as I say, a lot of the more high street banks are adopting this approach. And with that, placing these types of deals onto the high street will potentially allow the client to have a more high street banking pricing, potentially means lower rates, lower fees, rather than going more private banking route.
So you mentioned these two high street lenders versus private banks. What is the difference for the consumer here in terms of the products that are offered or the things that are normally attached to going down either of those routes?
Well, they both have their positives, of course, and we can't step away completely from the private banks because they certainly have their place with the way in which they approach. But discussing kind of the notional income that I mentioned there, why this is really beneficial for clients in those positions is that it does allow a complete dry lend basis. So many private banks may be looking for a long-term relationship with a client. It may be the initial mortgage and then be looking to further that, whether that be assets under management, etc. With a more high street bank, they are purely looking at the mortgage in isolation. So it allows them to keep the mortgage completely separate from any types of separate portfolios or wealth that they hold.
You mentioned high street lenders and you also mentioned the private banks. One reads a lot about these challenger banks, and are they also operating in this space, and what does the marketplace look like with them?
Absolutely. So it's not just the high street lenders that are adapting this holistic approach. There are many lenders out there, smaller building societies and challenger banks that have a very unique proposition. They are also aggressively pricing very similar to the high street as well. So it may be that they have certain characteristics in their criteria that can be very beneficial for clients in this position. And again, just another reason to kind of look at the whole of the market rather than thinking that this is something for a very specific private bank or the bank that you already have a relationship with.
Brilliant. So, that from our perspective, that's the benefit of using a broker. You have a view of the whole of the market. How do you stay on top of what's actually happening in the market? Is it just a matter of course because of the work that you do? Are there specific things that you're doing at Henry Donnell to do that?
Of course. So we're very fortunate that we have a very strong relationship with all the banks. And as a result of that, we tend to have monthly meetings with all the major banks and building societies out there. What that will allow us to do is maintain the relationship that we hold, but also as well keep on top of their potential new criteria that is being brought out. We're also always notified of any increase and decrease in rates and changes of criteria. So that allows us to then bring that into new meetings with new clients, as well as updating our existing prospects so they're aware of any potential changes, and just continue to monitor that for them.
Brilliant. So if we've got a barrister, say, who is at the start of their career and has got rapidly accelerating earnings, how do you approach that sort of case with the lenders that you're talking to?
This is a very topical point as well. So a lot of our clients, of course, being self-employed, maybe at the start of their career, people like barristers will have a sharp increase in their overall profits year on year. They may be at the start of their career where the standard high street is maybe looking at their position very black and white, and the average that they would use may not be able to achieve the lending that they desire.
So with barristers, when you have a really, really specific case and sort of niche earnings and so on, how do you take them on that journey with you? And how do you work with them and perhaps their clerks to get them across the line with the lend that they're trying to access?
Indeed. So we would look to work very closely with them and the chambers, accessing certain documentation that would allow us to position the case appropriately to these lenders. What that will allow us to potentially look to do is use, to say, the latest year's income or even future income by showing what they have banked, what is to be banked in the future as well. That gives the lender a lot more comfort, showing that trajectory and allowing them to access the lending amount that they require.
So thinking about technology, how do you anticipate it helping the client get to achieving their lend as quickly as possible?
Yeah, I think there's a lot of technological advances which will allow us, both on our side and the client side, to achieve the end goal a lot quicker. Ultimately, what this should do is allow us to filter out the possible lenders that can't allow the client to proceed with their requirements, and also as well speed up the overall process of achieving that yes and allowing the client to progress. And that kind of feeds into where we are in a potential volatile rate market. It allows the client to progress with the matter a lot sooner, securing that product.
Brilliant. Thanks, Jamie. And this is just a reminder that as professionals, whatever area we work in, there are certain areas that we just can't cover, and it's working with companies like Henry Donnell that allows us to provide our clients with access to these services to get them their desired outcome as quickly as possible. Now, talking to you, Stephen, with my advisor hat on, when I'm doing a fact find and I'm meeting clients for the first time, one of the things that I find is that young clients often don't have much protection, and the trigger point for taking out protection might be the first time that they purchase a property and they have some debt. Can you tell me a little bit more about that process and how you see things?
Certainly, you're quite right. It is something that I bring into the conversation, particularly with first-time buyers, as early as possible. That mortgage is a trigger. It is a massive debt. It is a liability. And we need to account for that with their protection needs. So we're always keen to have the conversation very early on to establish a budget, to establish the need, and then to establish a solution for them thereafter.
Brilliant. So someone purchases a property typically with a partner. They have the mortgage debt, and then the protection covers them if one of them or their partner should pass away, typically, so that the surviving person will be able to stay living in that property. So that's a very clear need where for some protection. What are the other types of protection that you would typically think about at that stage that might be appropriate for those clients?
So I would be thinking about critical illness cover, income protection, and some additional family cover as well. So perhaps if we start with the critical illness cover first, this is something that I am keen to discuss with everybody, and it's designed to pay out a lump sum on diagnosis of a critical illness. Now, the major 4 illnesses that lead to claims in the UK are cancer, heart attack, stroke, and multiple sclerosis. They account for 91% of claims in the UK critical illness insurance market. So they would be classed as your big 4. Now, there are other illnesses covered by critical illness policies, but much like any financial services product, no 2 policies are the same. So our job is to establish budget for the client, what's important to them, any medical history, for example, and then we'll have a conversation around how that critical illness cover can be structured. Is it going to be relative to the mortgage debt? Is it going to be relative to their income? And that's when we kind of go down different routes of establishing what type of angle we're going to hit. And there is no two answers the same. Every client will be different. Every need will be different. And that's why we assess that it's always best to speak to an independent whole of market advisor so we can compare those various options together.
Absolutely. So we've got the lump sum protection for a mortgage. We've got the critical illness cover, which is a lump sum on diagnosis of a serious illness. Can you tell us a little bit more about income protection and the way that it's typically applied and where it's most useful for your clients?
Certainly. So income protection will pay out a proportion of a client's monthly income as a monthly benefit when they are unable to work through illness or injury. So in terms of a bar being set for when that would pay out, it's perhaps not as high as a critical illness policy, but you do still need to meet certain criteria. And again, each lender or insurer will have different criteria to meet that. And how we structure the income protection conversation, again, is around the level of income one might be earning, particularly with those who are self-employed. Yourself and Jamie touched on barristers as an example, self-employed sole traders. Income protection for people in that nature of role is critically important because as soon as the work stops or income is unable to be earned anymore, self-employed clients may feel that quite more acutely than someone who's employed, perhaps with sick pay or other workplace benefits. So the income protection is designed to pay a monthly benefit, and that can be structured again to pay out, for example, over 2 years. It can pay out for a full policy term, and we may match that policy term to a planned retirement age or to the mortgage term, for example. And deferred periods refers to how long one needs to be off work before the claim starts being payable. So the shorter the deferred period, the sooner the policy will start paying, and the shorter amount of time one has to be off work. The longer the deferred period, the longer one has to be off or unable to work before that benefit would be payable. So there's different ways of structuring the same policy to suit budget, to suit need, and it can be different for, as an example, a first-time buyer couple. One may be employed, one may be self-employed. They may have a slightly different income protection policy structure. But we're always keen to have the conversation with everybody, regardless of their workplace benefits or their self-employment status. And something that I think is critically important to consider when we do see workplace benefits sometimes shifting or changing, being altered by employers in some instances, it is good to have that independent policy separately to ensure that you're covered regardless of what your employment contracts may offer.
Understood. Yeah. And when I talk to clients, they often consider what income do I need to cover my base costs, as in my mortgage, my living expenses, and so on. And one of the things I always remind them is that in the course of their life, they also need to think about retirement and saving for retirement. How do you approach encouraging them to take up perhaps a little bit more income protection than they think they need? Do you focus on that need to continue saving for retirement? Are there other things that you're thinking about?
Absolutely. And this is where the wider financial planning relationship with Rathbones and Henry Donnell is so critical and so beneficial, because having that close working relationship with you as the financial planners, we can understand that picture of what's important to the client and their longer term goals when we're shaping the advice. So if they're planning to retire by a certain age, if they're planning to exit a business, for example, we can look at tailoring the solution in line with that. You make an excellent point about covering all eventualities. If somebody is saving a certain amount of their income per month, for example, investing into a pension or another long-term savings plan, that should be accounted for, because that is something potentially that, with the loss of income through illness or injury, can't be funded anymore. So that then can lead to a change in retirement plans or planning needs with you guys. So yes, absolutely, we take that into account, but it all comes back to understanding the client need from the word go, and then making the plans together.
Brilliant. And one of the things I say to my colleagues is we have a huge amount of responsibility as financial planners. We have to stay on top of legislation with regard to pensions, which seems to change every year. We have to stay on top of tax, different rates of tax, CGT, dividends, inheritance tax. We need to think about a huge number of things. It's very, very hard for us to stay on top of everything, and that's why we lean on providers like Henry Donnell to fill those gaps where we simply can't cover all those places. in terms of just looking at the protection market and maybe thinking of how that market changes over time, what do you see with the different providers? Do they change their criteria very often? Do you have to keep reassessing who the appropriate lenders are for particular cases? How do you stay on top of all of that?
So yes, we keep on top of what providers are doing in that space. We are in regular dialogue with the insurance companies. There has been a bit of a consolidation in the UK insurance market of late, but there is still a lot of choice and there is still value in speaking to an independent advisor. So we will regularly assess the types of conditions that are covered, for example, in a critical illness policy or an income protection policy, because no two are the same. It may be that one will offer children's critical illness cover, for example, where another doesn't. Now, as a parent myself, it's an awful thought of my daughter needing to make use of that, but that's when I will need it the most. God forbid it. I need to make sure that I have something in place. So we make sure that we are up to date with the additional features provided by different insurers and communicating that. If we're making a recommendation for an insurer that perhaps a client hasn't heard of or a client doesn't have experience of, we need to make sure that the advice is robust. And the way that we can do that is by staying regularly up to date with the changes in the policies and what's covered by these insurers. Great.
So we've spoken quite a lot about critical illness cover, income protection. We spoke about the lump sum cover in terms of a mortgage. A lot of clients might want to take some additional lump sum cover. How do you approach that, and what sort of criteria are you looking at for the suitability?
So I would refer to this as additional family protection, essentially. So they've got the mortgage covered, as you've mentioned. We have a policy set up to look after that. Now we need to set up something that's going to assist over and beyond. So once the mortgage is cleared in the event of death of either of the insured parties. So we would be looking at the sort of lifestyle that one would want to maintain, or one's partner or family would want to maintain in the event of their death. So this would be, for example, to cover ongoing school or nursery fees, which also need to be factored in. Having a mortgage-free property is one thing, but then allowing your children to continue on their chosen educational path may be, if you have lost an income in a household, not possible without that additional policy. So that's what the level term policy would be useful for. In one example, covering of school fees. It could also be used for inheritance tax liabilities. So I would stress that we are not inheritance tax advisors, but if a liability has been identified, we can assist with a level term life assurance plan that, for example, would cover the liability for the amount of years that liability remained in place. So they would be a couple of examples of where the level term lump sum life assurance policy would be useful over and above a mortgage policy or over and above a critical illness policy.
Great, thank you very much. Thank you for joining us today at Financial Planning Unlocked, and thank you also to my guests, Jamie and Stephen, for their insights. We look forward to seeing you at the next episode soon.
This podcast has been produced for information purposes only and isn't intended to constitute financial advice. The information contained within this podcast is believed to be reliable and accurate. Rathbones is under no obligation to update or keep current the information contained in this material.